Hello and welcome to Freight Forecasting. I'm Michael Vincent, Freight Forecaster here at FreightWaves, and I've got my very good friend, Mr. Anthony Smith, who is the lead or head economist. Which one is it?
I think the lead economist.
Lead economist.
This week.
This week it is?
This week, lead economist.
You like to change it up?
Switch it up. Director of Market Experts,
Yeah.
FreightWaves enthusiast here.
Yeah, awesome. Well, I got you on the show today, and thank you for coming on the show today. And what we're going to cover here is I've got 5 dashboards, and I'm calling them the 5 must-haves from the C-suite all the way down to the brokerage level, right, to the brokerage floor,
right,
if you will, the boiler room floor type of thing. And I think they're highly useful. You and I have spoken about many of these indices, a couple on different shows that we had here. So I combined them all into one show so we could kind of go through this. I think the time right now is really ripe to go through this, talk about these different data sets, show it in Sonar and how you can visualize it in Sonar. You can also, grab this stuff through API and bring it into your own system. But the point is the data and the ability to be able to analyze it, chart it, dissect it, digest it, and then take action on it. Whether it be long-term plans, knowing where the economy is and what sectors are coming up, down to absolutely today, where do I need to have my assets, or where do I need to worry about covering my customers' freight, avoiding hurdles, or, how am I going to maintain my margin today?
That's exactly right. Yeah, and
right?
I tell people so many times that's a powerful pairing, is when you're looking at these macro data sets, a lot of them month to month, they move a little bit slowly, but when you have something like that a little bit more near real time, like the outbound tender rejections, the haul, the volume index, and things like that we have in something that's proprietary, we could see near real time, just yesterday's numbers, it's a powerful pairing to kind of see how to navigate, how to pivot in the market.
Yeah, it absolutely is. And some of these numbers are, what do you call it, a lagging indicator, is that right?
Some of them are lagging. Some of them are leading indicators, but they're released on a lagging basis. So we're looking at numbers that are based for March, but we're already through April now. So that's how they can be leading but lagging at the same time in terms of the release. But when you have data as of yesterday, almost everything is going to start looking like it's lagging at that point.
Yeah, it really is. But that is very, very important to dissect what happened, right?
Right.
You need to have that context of benchmarking your own company's performance within the context of similar industry, your cohorts,
right,
your peers within an industry, competitive cohorts, if you want to call it that, whatever you want to call it, but within and the overall market.
Right.
Was it just our business that was down? Was it just us that sucked last month, or what was it?
Yeah, and then you can get this. This is one of the things you just mentioned. Great for the C level as well, all the way through top to bottom. One of the things that executives like to look at, that I recommend that they should probably be looking at, is different verticals, right? And so when we're dissecting those monthly macro trends, they're great for looking at either verticals that you might not be into. So maybe when we're looking at manufacturing or industrial production, we can get really granular with that. And then you can do that comparison, like you said, to see which areas are accelerating or slowing down, and how you're comparing to the overall market, and then break it down to extra granularity and looking at what's happening within the freight industry as well. So doing those kinds of comparisons is key.
It is, and giving you the ability to, if you have the ability to, and hopefully you do, is not only diversify your portfolio, if you're a carrier or a broker or even a manufacturer, but specifically your supply chain, but also on the other end to really pivot what you're moving. We've spoken to many people on what the truck and on the coronavirus freight market update, and even on this show as well, where people have they were hauling this particular product, but then they've switched due to necessity of the coronavirus. Right. But when you have economic cycles, they don't always follow each other, right? It could be in different sectors where the cycle is changing, and knowing which ones are changing can give you the ability to shift some of your assets here, some of your focus there, where things are growing and not so great in your traditional vertical, right?
Right. And a lot of times I find with trucking or any kind of transportation, a lot of people are late to the party. They'll see this robust growth one quarter, try to jump into it, but by then it's usually too late. You should have been already planning and anticipating this. And so really kind of, like you said, pivoting, getting ahead of that curve is key.
Awesome. Well, We're already 5 minutes in, so we need to get moving, and we haven't even shared my screen yet.
Let's do this.
Somebody predicted that. I'm not going to say who. So the first one that I have up here is now. Would you call this lagging indicators, or these are? Well, this is what was telling us what happened last month, right? And so I have up here, and I'd like you to kind of go over what these are. I can, but you're an economist. You can do it a little bit more clearly than I can. So we have the ISM, or the Institute of Supply Chain Management, and metrics on the left-hand side. And specifically on this chart, I have the PMI.
Right.
And on the other side, I have the Logistics Manager Index and the composite measure up there.
Right. And so, yeah, just as you mentioned, when we're looking at the one on the left-hand side, the ISM PMI, that's the Purchasing Managers Index, and so that's the diffusion index. I think it's one of the more popular diffusion indices that's released. There's a few other PMI indexes, but I like to look at the ISM. And so when we're looking at this is based around the number 50. So anything above the number 50 is indicative of expansion within the manufacturing industry. Anything below 50 is indicative of contraction within the industry. The latest reading, actually, Mike, we get new PMI numbers tomorrow, I believe.
Yeah.
May 1st. So Friday we're going to get a refresh on this, and that's going to show April's numbers. But like you mentioned, it's not showing that up to date. It's showing what happened throughout that month. So it's a nice summary, but it's not kind of forward-looking. If you want to be forward-looking, you got to have kind of dissect some of the components of it and then kind of come to your own
The different
analysis.
components of the ISM.
Right.
Which I have listed here in the gauges.
Right.
Right? So I have all the different gauges up here. So you have non-manufacturing new orders index, non-manufacturing index, the manufacturing inventories index, et cetera.
Right.
And then you have this manufacturing supplier delivery index, which is at a 65.
Yeah, that was one of I think the only one to kind of really have any kind of growth, and that was some pretty substantial growth as well.
But isn't that the one that's considered inverse of the others?
Yeah.
The 65 is not necessarily a good thing. If the PMI Purchasing Managers Index was a 65, we'd be like,
Yeah.
right?
Yeah.
But a 65 in this particular one in the manufacturing suppliers deliveries index is not necessarily a great thing.
No, not necessarily. And then that really kind of shows the not exactly the backlog, but even though this is manufacturing, there is a slowdown for a lot of that stuff, especially when we saw the pull forward for the other segments facing consumers. We're looking at, of course, those food. During March, we had that big pull forward with a lot of those food items now. And so, like you said, that's not an area that we're really anticipating to provide any kind of upward momentum for manufacturing overall.
So when we're watching this peak over here in June, and then start to drop, and then you've got some holiday action in the fall, which wasn't great, and usually does drop at this time, right? And then you have this spike, which usually happens in January, and then this start to drop off. This is not normal.
Yeah, and so this is really, when we're looking at this downward movement here, this kind of indicative of manufacturing being weak throughout much of the latter half of 2019 especially. And a lot of that's going to kind of come around through back then. We were all worried about trade uncertainties and the tariff war.
That's right.
And so that really is going to be indicative of some of that downward movement. So business investment was really low around that time, and that's when we saw businesses really kind of curtail some of their spending. A little bit of uncertainty, some trying to find alternate routes going through Southeast Asia instead of going to China, and trying to figure out different solutions for that.
Yeah, so I don't want to call myself ignorant, although many do, so I don't need to. When I look at this and when I think of what is going on right now, are you expecting this 49.1 to kind of stay hanging around there somewhere?
I'm expecting some downward movement here.
Are you?
I wouldn't be surprised if it dropped somewhere down into the 30s.
Really? Because I'm thinking of this from the terms of, okay, the economy's starting to come back on and stuff like that, so the sentiment may be a little bit more positive? But
yeah, so when we're looking at the next release, it's going to be showing April, and so we're just now finishing April, and we haven't seen a lot of that manufacturing activity come online just yet.
No, but the talk of coming back on, would that not have influenced this? Just the planning for it? No,
not too much. No, I don't think so, because they're looking at what's happening now. Now, one of the indexes or components that's in here, the new orders, potentially. That's going to be the more forward-looking, depending on what's happening.
And that's the next screen. So let's get to the second half of this, because
Yeah.
we got to move on to the next one. We got a lot to cover today.
We do.
But like I said, I put out in my LinkedIn post yesterday to promote the show. After the show, if you hit me up on LinkedIn, or you can hit up Anthony Smith as well, we'll send you links if you're a Sonar user to all these dashboards, so you can have them built into your Sonar dashboard, so you'll have them yourself. So now I have the LMI Index.
Yes.
And when you look at this and you see the PMI, the ISM PMI, or the Purchasing Managers Index dropping, that would be indicative of slowing and contraction.
Yeah.
When you see a spike like this in the LMI, now this is the actual movement of goods.
Yeah.
This is measuring inventory levels, inventory growth, costs, shipments, all that.
Yeah.
The logistics, when you think of supply chain movement.
Exactly right.
This spike would indicate positive times.
Freight was moving over
And
this
it
time.
was.
Yeah.
It was moving like crazy.
Yeah.
So we would expect this to drop.
Right.
Severely.
Right. And this is a great index that looks at not just manufacturing, but Mike, as you mentioned, it's looking at everything. So it's looking at consumer stuff as well. And that's what I like about it, and doing the comparisons between this and the PMI. And then even when we're looking at this again has different components to it. So there has LMI, I think there's a pricing component to it as well. And we kind of see similar trends with that as well when we saw that
it's got
spike
transportation pricing, which is the only, which is 6552, which is enormous.
Right.
And it's also got transportation capacity. It's got the composite measure that you're looking at. All these things feed into it to make this 58.87. But you've got all the different components broken down here by gauges. And even though we saw this thing go up, warehouse capacity, warehousing prices, warehousing utilization are all setting 52-week lows.
Right.
Which is not good.
No, not at all.
Warehousing was draining, as we were talking about a month ago.
Right, exactly right. And this is one of those things where you can't look at one specific area and expect that to be indicative of the entire industry. And that's the key of when it comes to freight forecasting. And the LMI, similar to the PMI, anything above 50, indicative of growth, anything below 50, indicative of contraction. This is a collaborative effort put together by Arizona State University, Colorado State University, Rochester Institute of Technology,
Is that what
University of Nevada,
Nice.
Rutgers.
Giving some shout outs?
Yeah, all these folks, Zach
Is
Rogers.
New Mexico in there?
Not New Mexico State, unfortunately. Go Aggies. But all those universities collaborate, pull it together. Zach Rogers and Dale Rogers are the two that are kind of really leading the charge on a lot of this stuff, and it's a great index to look at.
It's incredibly useful, because if those two were moving in tandem, now you've got a really strong thing.
Right.
And normally they would. Well, I guess normally they would, right?
Right.
I mean, the COVID-19 and the pandemic purchase buying, the preponomics factor, as you coined a phrase or a word, caused them to diverge completely.
Right, and that's exactly why you always mention, don't look at just one index, don't look at just one indicator. Look at 3, 4, 5, and kind of look for similar movements and similar trajectories for these.
Yeah, I would suspect that the LMI composite, the Logistics Manager Index composite, which is measuring everything moving, right, would kind of be predicted by new orders, and the PMI would lead that, right, and those are low. So that spike is not.
It's not going to be long lasting.
No,
not at all.
It's going to come down. So let's move on to the next one. So the next one, those are kind of looking backwards or kind of validating what happened and kind of dissecting what happened last month and through the eyes of the Purchasing Managers Index and the Logistics Manager Index. This next chart that I have here, or dashboard, is what we're looking at here are orders.
Yeah.
And we also have production. Right. Now, I have pulled up here because we spoke about these two in the same episode many weeks back.
Right.
But so non-defense capital goods, excluding aircraft, is one of the ones that you put out there as the must index to watch for recovery.
Yeah. Because when we look at this, I mean, this is another one that's it's lagged. It is what it is. But it's a great index because it's going to be showing. It's indicative of showing business-to-business activity within the economy. It's looking at capital goods, new orders, stripping out the defense component, which can be pretty volatile and large and can sway the overall trend. Although if you can negotiate any kind of contracts or anything like that with the defense side, that's a great way to go because that can be a lot of business, especially during downtimes.
Yeah.
And it takes out aircrafts, another big swinging component that can really kind of sway the trend. So looking at that, non-defense capital goods new orders is a little bit more tangible because it's not based off of, okay, what am I seeing? These are confirmed orders that have come in already. So I recommend this one being one to look at and looking at it in all different kinds of ways to see what kind of looks best with your internal trend. So you can look at this just the month-to-month numbers. I myself looking at it on a year-over-year basis as well.
Okay.
Where you can kind of start looking at trends.
Yeah, which we can easily do just by coming into this little tool here, display, and showing seasonality.
Mm-hmm.
And I've got the large font on here. But now you can look at the year over year,
right,
as to what's going on,
right. And so I recommend looking at chopping it up any and every way, and finding out which one's best for you, and doing those internal comparisons to see what's happening, not just with other segments of the economy, but internally as well. Are you optimizing yourself?
Yeah. So before the show, you mentioned new orders.
Mm-hmm.
Is something that you would always look at, and I don't have a chart of that. Do you want me to pull that up? Should we look at that?
So new orders for the ISM or?
I think it's the ISM that you.
Oh
said.
yeah, we can. So we can pull up. I think it's ism.mnew. We can pull that one up. That's a pretty good component. To
N-new.
mnew.
M-new. Sorry.
Yeah, that should be
manufacturing new orders.
correct. Yeah.
So
yeah.
what exactly are we going to look at here?
So we can look at that, and we can also compare it to either. So this is a good one to compare to. So we can even go with one of our proprietary indices, Flatbed outbound tender rejections, FOTRI.USA. One of the equipment types that's typically hauling these manufactured goods, and of course have that on the dual and all that good stuff to kind of get that closer comparison. But we can see what's happening right now within Flatbed, and knowing that the rejections are ridiculously low right now. That's speaking to
1.29.
That's insane.
1.29 means that the carriers are doing a really good job of having capacity where it's needed.
Right. That
is what it means, right?
Exactly.
Because they're only missing 1.29% of the loads. Therefore, they're doing a really good job of getting their capacity where the loads are.
Yeah, and it's showing that there's not a lot of capacity strain with these flatbed trailer types.
Like none.
And when you're looking at that, they typically haul manufacturing and construction materials, right?
Yeah, right.
Depending on, of course, the specializations of some of the flatbed decks. But this is really showing right now that as of yesterday, throughout the last week, rejections have been ridiculously low. And that can be a hint, even though it's a day-to-day movement, it can be a hint to the overall trend for some of these macro indices that we're waiting to see. And so that's why I love this powerful comparison. It's just that it shows you what's happening near real time.
Right.
Then you can do that comparison with
so now, let's look at this other side, because we do need to keep moving on here, and we can dig into these deeper on another episode.
Definitely.
Which would be really interesting to do. We could talk for an hour just on one of these and
we
implications on how to do it, right? We do this all the time. But so now we have iPro.
Yep.
And I've got food, which is industrial production.
Yep.
And I've got food, beverage, and tobacco up here right now. And the reefer.
Right.
Right? Because you can tell what's going on either way.
Mm-hmm.
Looking at reefer volumes, you can tell what's going on in the food, beverage, and tobacco industry.
Right.
And looking at the iPro, or industrial production indicators for food, beverage, and tobacco, you can tell what's going to happen for reefer.
Right.
And you can see that very clearly here. What I'm pointing out here is we've got this uptick, even though I would imagine this is dropping. But with restaurants coming online, do you expect this to come back up?
It can start to
or
come
maybe
back up.
Flatten?
It can start to come back up somewhat. Again, a lot of that's going to come down to, because it's such a pieced together thing, state by state, city by city. I don't know if it's going to be enough to move the needle, but there's a good possibility.
Yeah.
The other thing is, we chatted about it on one of the shows yesterday. A lot of food processing plants having to shutter operations because of outbreaks internally. So this is going to be one that's going to be interesting.
Does produce season affect the industrial production of food, beverage, and tobacco index?
I believe so. Yeah.
Okay.
And that's
so
one of
we
the
would
areas-
expect that to have some effect on that, or I think you're starting to see it in the volumes a little
Right.
bit because it's on us.
Right.
We should be entering it right now.
Right.
In fact, we saw it. I think in Oregon, it started.
Yeah.
Yes.
Yeah. And
The other things that you have there, though, I'm looking at industrial production for food, beverage, and tobacco, but we've got all the other verticals that are in here.
that's key. That's
You got
huge.
you got motor vehicles and parts.
Yeah.
Right? Motor vehicle, what's the difference between these two? Oh, year-over-year change. I've got the
Yeah.
year-over-years as well, right?
Yeah.
So I could, if I click on this and then close this chart, now we're looking at motor vehicles year-over-year change.
One of the hardest hit industries after COVID-19.
But this
took
cliff
over.
here is not good?
No bueno.
No bueno.
No bueno.
No bueno. Yeah.
But-
minus 26.48.
Yeah.
Not good.
Not good at all. But just as you mentioned, you can dissect this by market when you're looking at the different verticals, and that is so paramount. I can't stress it enough because
It really is.
you can
it really
you
is.
can really dissect which verticals are moving, confirm it with our data sets to see, okay, what's capacity looking like for this equipment type, what are
Yeah.
volumes looking like on this equipment type. Then if you're even going to chop it up even deeper, start looking at different lanes where you know these factories are running.
But
And
you're exactly right. And so let's move on to the next one, right? You got all these you could go all through all the different verticals in
Yeah.
both of these, just like you could when we were looking at the LMI and the PMI. You got
Right.
all the different verticals you can dissect. Now, maritime is another one.
yeah,
And so imports do affect our surface transportation.
definitely.
Right?
Definitely.
We were looking at productivity, and that's domestic productivity,
Right.
correct? So now we have another piece of the pile, the world economic scene,
Yeah, yeah.
right? And how that's affecting us. And so what I have over here is I've got the exports to the United States by origin port,
Yeah.
which then you can click on any one of these and chart those levels. But I also have next to it the U.S. weekly customs imports by our domestic ports or the destination ports in the United States. So you can
Right.
see both ends of
Right.
what's going on. Now, you could put each lane, but the tree map would be so huge, it's not even funny. You'd have
Yeah.
to filter it down, and you can filter that down and build different things. But what we're looking at here is the maritime imports into the port of Los Angeles, and then its effect on the rail. And you can see they are perfectly in line with each other.
Right.
Imports
Right.
come up, intermodal, obviously loaded boxes move up. And you can see this move down the chain. We did this in the last show, I believe it was, or a couple shows ago, where you can follow this through to destination.
Right.
You can follow this particular O-rail outbound Los Angeles into Chicago, Memphis, Atlanta, Dallas, and then you can start to see the effects on the local truckload market, and then the short haul, the mid haul, the tweener, and then the long haul start to grow from there
Right.
as that moves. The interesting thing, though, about this is that's pretty ugly looking. But if you if you look at this, it's not a great scene
Yeah. Yeah.
of imports coming in, as Greg Miller reported. You got the blank sailings that are happening, and the reason they're doing those blank sailings is to uphold their rates, which you also have the maritime rates inside here, and I have them here year over year, right?
Yeah.
Listed, so you can follow those rates. It's to prop those up, because otherwise the carriers, the alliances are they can go out of business,
Right.
and they can't do that. They can't lose $26 billion. I think they were estimating they could possibly lose if they left their capacity where it was.
Right.
Demand's not there, capacity goes down, or blank sailings, I should say. Which, we had a report on American Shipper that I believe Greg Miller did, was Port of Oakland is looking at it. So the larger ships coming in less frequently,
Yeah.
which puts a delay in your supply chain cycle.
Right.
So you could see lower volumes, or you could see, sustained volumes or even upticks in volumes, but slower cycle times because of the larger ship. So you got to look at the slots on the ship that are filled, and the pricing is going to give you a good indicator of whether the capacity is under constraint in maritime.
Correct. Yeah.
So then when we take this and move down, we come to the next dashboard, and I have one more after this. Now, these are familiar with by many people as Zach utilizes these quite a bit. Our director of freight intelligence on FreightWaves now uses these quite a bit. I like this dashboard because what I have set up here is I've got the volumes or outbound volumes, all modes, by length of haul on the left-hand side. And so if I move this, I see that it's quite busy here.
Yeah.
But
Yeah.
I've got the long haul, I've got the local, I've got the short, I've got the medium, and I've got the tweeners, long haul, and you can gauge. These are the U.S. volumes, and you can see it's been on the uptick.
Yeah.
Right? So you see the volume index is moving up across the board here. And if you look at all of them, which is right here, and let me stretch this back out here to 3 month, you can see we're sitting at 9,000. So Craig Fuller, our CEO, set the bar at 9,300 on May 15th.
Yeah.
I spoke to him yesterday evening. He was dropped by the office real quick, and I told him we're going to hit 9,300 before the 15th.
Interesting.
Is where it looks like.
Yeah. Yeah.
I mean, you've got this, because if you look at this, van is leading the charge.
Yeah.
There's reefer, and produce season is about on us, and we're already at 9,000.
Right.
300 is not a big leap with produce season on us, and auto manufacturing coming back online, et cetera.
A lot of catalysts here.
A lot of catalysts that are going on. So you can look at it length of haul, and then I have the outbound tender rejects by length of haul, which would show you that there is not there's no issue with capacity on the length of haul. It's still it's down here. You're starting to get a little uptick in short haul, this yellow line right here, but there was a little bump in the local as well due to the imports starting to hit those Dallas markets, et cetera. Right. So this is something you need to be looking at. But if you look at this in the middle, I've got the modes across the United States, and for the first time, well, you still got van outbound tender rejections are setting 52-week lows still.
Right.
But you have reefer and you have flatbed that have actually come off the bottom.
Yeah.
Hopefully they gain momentum.
Hopefully.
But it could be what do you call it, dead cat bounce or whatever.
Dead cat bounce, that's an economic term, yeah.
Yeah, it is, right? I heard that once. Did I use it right?
You did.
All right. So then I've got it by mode as well. Outbound tender volumes by the modes was what we were just talking about, but then the outbound tender rejects, which you see in these gauges that are giving you the 52-week high and low and where they're at. But I also have them listed right here so you can see the trends and all. I mean, they obviously all follow that same COVID-19 spike, boom, and then come back down.
Right.
What you're seeing right here is that uptick in flatbed, the uptick in reefer, and van continues to just a slow slide now. It's not a dramatic cliff, but it's still a slow slide.
Right.
So if we see new orders start to pick up, and we see the PMI index start to pick up, that would be indicative that you should see this blue line, and really all the lines start to come up. So that would be your indicator a couple weeks out, a month out?
Yeah, it could be an indicator of anywhere, depending on the segment.
Depending on the segment, right? So you got to dissect everything.
Yeah. But like just so you say, you start to see new orders starting to pick up. You start to see business investment that come back online. I don't recommend paying attention to the headlines, but when you're starting to see kind of incentives being put into place to kind of prompt certain industries, it's a good telltale sign of what's actually happening.
It is. Okay, great. So last one real quick that I wanted to get to was now tactically. Boiler room floor.
Yeah.
Right? I'm looking at most volatile markets, and this is going to tell you today what is happening in these markets. Who are the strongest movers with their outbound volumes, with their outbound rejects, the head haul volatility, and their tender lead times, and then you can quickly chart these. Now, I have Seattle out here where you're seeing that their outbound tender rejects start to spike over there. Now, spiking at 2.12%. Let's keep that in mind. It's not 10% or 25%, but it is going up. So they've got some capacity constraints there, and it could be produce season starting to come on and suck some of that capacity south of them a little bit,
Right.
Because their volumes did spike, but then they've dropped their outbound tender volumes. But this you can then you can look at this and look at, okay, outbound tender rejects, where is capacity the tightest? And you can click up here and look that you've got Eau Claire, Charleston, and Seattle have moderate increases. And then you have these moderate decreases, a strong decrease in tender rejections in Lubbock, meaning that capacity is extremely loose there. But then you have this host here that's just in the middle that aren't strong, moderate, or weak, up or down.
Right.
They're just kind of sitting there now. 2.31% uptick in Rapid City in outbound tender rejects, meaning tightening of capacity. So these are giving you outside the norm. Here on the watch table, this I like on a daily basis because this is giving me the inbound tender rejections, inbound volumes, outbound rejections. So the inbound capacity constraints, the outbound capacity constraints, et cetera, without looking at outside the norm. So where are those opportunities that I have here? And you can do the same thing if you look at your outbound tender rejects. I can click this and do it by value and show, obviously, right here, Rapid City, South Dakota is the highest.
Yeah.
Eau Claire, but Minneapolis at an 8.48, right?
I mean, this is amazing.
St. Cloud at a 6.63.
Yeah.
Right?
Yeah.
Green Bay, Wisconsin at 6.58. So you can see where these things are moving, and you can see it by the percent of change, too. Now, that was the actual value, but we can do it by change. And so you can see Spokane.
Yeah.
71.5% increase night overnight in outbound tender rejections, capacity tightening.
That's substantial.
This is your tactical first thing in the morning, boom, set alerts through sonar. I know where I need to go first thing in the morning.
Right. Right. And I think throughout this entire show, you did a great job of storylining every single segment of freight forecasting and what it should mean to everyone involved.
Well, thank
in the
you,
business.
Anthony. That means a lot to me.
Yeah, I think you did a great job, Vincent.
Awesome. I've got a boss. So can I introduce
I'll send
you
an email.
All right, send out an email. Hey, listen, thank you for joining us. We went a little bit over on time today. Sorry about that, production guys, but we had a lot to get through. What I call the 5 most important dashboards or must-have dashboards is what we just went through. Hit me up afterwards, and I'll send you the link if you're a Sonar user, or hit up Anthony. He can do the same. If not, hit us up anyways. We'll show you what you can do or get you in touch with one of our Sonar reps or market experts to talk you through what exactly you can do within Sonar. Many of these indices are proprietary. Most of them are proprietary to Sonar. Many of them you can get yourself. You can get the LMI, you can get the PMI, et cetera, yourself. But they're all in one place so you can dissect it against other proprietary indices like all the truckload, et cetera, inside there. Highly important stuff. Thanks for watching. See you next week, 4 p.m. on Thursdays, Freight Forecasting. I'm Michael Vincent. He's Anthony Smith, our lead economist. Peace and love.